participants to join in. Thank you. Good afternoon again, ladies and gentlemen, depending on where you are. I think we can get it started. My name is Marina Finken. I'm the Partnership Coordinator for Making Finance Work for Africa, and it is my pleasure to welcome you to this webinar on behalf of the European Investment Bank and the Making Finance Work for Africa Secretariat. I will also like to take the opportunity to thank the European Investment Bank, EIB, for associating the Making Finance Work for Africa partnership to this flagship report, the Annual Finance in Africa report, on the theme Unlocking Investment in an Era of Digital Transformation and Climate Transition. This is our last webinar for the year, and this is now a tradition for Making Finance Work for Africa to wrap up the year discussing the funding of this annual report. So I would like to thank you all participants for joining us today. It's always a pleasure to see and a pride to see so many of us agreeing and accepting our invitations to our virtual gatherings, where we exchange ideas, we share best practices, and ultimately we try to find long-lasting solutions to make Africa work, to make finance work for Africa. So without further ado, we will start our session. Before we proceed, let me give you a quick reminder of some housekeeping rules. So we will be today for an hour and a half. I will give you the sequence of the session later. For better listening comfort, all your microphone are disabled for the duration of the webinar. So we will ask you to remain mute, please, and you will have the opportunity to ask some questions during a dedicated Q&A session. And you can also submit your question using the Q&A button at the bottom of your screen. The session is available in English and in French, so please you can use the translation buttons to choose the language which is the best fit for you. And as usual, we will share with you the recording of this presentation and the slide within 3 days following the webinar. And if you have any issue, please, you can send a message to the organizers and we will do our best to assist you. Last but not least, at the end of the webinar, for the one who are used to our series, you will have a questionnaire automatically appear on your browser. So please, if you can take a few minutes to answer it, it's really important for us to make sure that you will be able to invite you to more insightful session. Now, this was for the housekeeping rules. So the outline of the session. So we will start the session with a presentation because, as you know, we are here today to discuss the main finding of the Finance in Africa report for 2024. So we will start the session with a presentation made by Mr. Colin Birmingham from EIB, which will give a brief presentation of the main finding of the report and also the methodology to come up with these findings. And after the presentation, we will have a panel discussion moderated by Mr. Ricardo Santos and esteemed panelists that he will introduce. And as usual, we will end the panel discussion with a Q&A session where you will have the opportunity to also ask your questions, and then we will close the session. So thank you again, all participants, for your presence. Thank you to our esteemed panelists, which will be introduced later on, and I wish you a very insightful webinar. So Colin, over to you for the presentation of the result of the report. Thank you.
Thank you, Marina. And let me also take the opportunity to thank Making Finance Work for Africa for hosting this webinar to celebrate the launch of the report, and also to thank them for their continued support with the report, helping us with the analytical content and with the dissemination of the survey. So it's been a very fruitful collaboration between the two institutions over the last number of years. Next slide, please. So this report, Finance in Africa 2024, is the 9th in the series. It's covering banking, financial markets, climate, digital, fintech. So it's quite a broad report taking a deep dive on the financial sector in Africa. It draws on a variety of data sources, and amongst them is a survey that we do ourselves of banks across sub-Saharan Africa. So this year we had 51 banks which responded to the survey. So when you hear me throughout the presentation talking about the survey, this is what I will be referring to. And the survey was carried out this year between February and March. So the first thing that I would like to discuss in terms of the report is how financial conditions have been changing and what the trends are. So the report includes a financial conditions index for Africa, and that index is tracking financial conditions across 10 countries based on a combination of 7 macro and financial variables. So the index there is the blue line, and when the line is going up, it means financial conditions are becoming looser and it's becoming easier for corporates and for governments to borrow on financial markets, whereas when the blue line is going down, well then financial conditions are tightening. So what we saw after the pandemic was that financial conditions tightened initially, but then when central banks basically enacted large stimulus packages and rate cuts, this calmed the financial markets. It helped in terms of the stock market. So we actually had a bit of a loosening of financial conditions for a while. But the war in Ukraine changed all that. So the inflationary shock unleashed by the war forced central banks to reverse course. They had to enact very significant policy tightening. We had a souring of risk appetite, international risk appetite, and exchange rates weakened for a lot of African countries. So you can see there from middle of 2021 onwards, we had the largest peak to trough tightening in financial conditions in Africa that we've seen post the global financial crisis in 2009. The financial conditions have started to improve a little bit, since 2023. So inflation has begun to ease. There's been some, policy easing. Stock markets have started to perform a bit better. And at the beginning of 2024, we also saw some countries in sub-Saharan Africa start to regain access to international bond markets, like Cote d'Ivoire and Benin. But still, you would say that financial conditions remain tight relative to historical trends. Another indicator, thanks, yeah, next slide. So another indicator that we have in the report is a severity of crowding out index. So crowding out referring to the situation where banks lending to government is making less bank funding available to the private sector. This is based on a collection of about 12 or 14 variables for each country. So it's quite detailed, and I think we have about 40 countries in total across the regions here. So it's quite a detailed calculation. I won't go into the various regional trends, but if you look at the bright blue line there, which is the index for Africa as a whole, you can see again in 2023, these crowding out pressures reached a peak because you still had a lot of supply of government debt. So governments were still borrowing to fund their deficits. And this was being met by demand from, a resurgence in demand for lending from the private sector. So those competing forces were reaching a kind of a peak intensity in 2023. In 2024, that started to ease again. So governments are starting to kind of pare back deficits a bit, and as financial conditions improve, the availability of funding from other sources is also helping. So the crowding out index and the financial conditions index both show a tightening in financing conditions, which peaked in 2023. Some cyclical improvement in 2024, but financial conditions still being relatively tight by historical standards. What we also want to highlight in the report are the structural issues which are caused by a lack of access to finance. Next slide, please. So there has been slow progress on some development indicators in Africa. I'm not going to go into the charts here in a super amount of detail, but there's two basic points here. If you look at the chart on the left, which is showing the share of global GDP by region between 2003 and 2023, so over a 20-year period, the share of global GDP accounted for by sub-Saharan Africa and by North Africa has barely budged over that period. In contrast, you can see the share of global GDP accounted for by developing Asia has basically doubled. So you haven't seen that sort of growth in Africa. The chart on the right is showing the evolution in the form of an index of income in real incomes in local currency terms. The blue line is sub-Saharan Africa. The orange line is advanced countries. What you can see is that, again, over kind of a 20 or 30-year period, the trends have been very similar. So, you haven't really seen, what that's kind of saying is you haven't really seen much in the way of income convergence between, sub-Saharan Africa and advanced countries. And when it comes to North Africa, it's even lagged what we've seen in terms of the advanced countries. And the other thing to note is that there has been a flattening in the upward trend in income, which preceded the pandemic and the war. So one of the issues here, in our view, is the relative lack of development in the private sector. So we haven't really seen as much private sector development as we would like. And this, next slide, please. This is also being kind of reflected in a low level of industrialization over the last 20 years. So the chart on the left there is showing the share of GDP, the sectoral shares of GDP by region. So you can see when it comes to industry, which is the first group of bars on the left there, and the light blue bar is sub-Saharan Africa, it's the share of industry in GDP is about 25%. And you can see that's lower than what we have in other regions. Also, if we look at the chart on the right, and this is comparing sectoral shares of GDP by income group rather than by region. And if you look at agriculture, which are the bars on the right-hand side of that chart, you can see for high-income countries, agriculture has a very low share in GDP. Actually, it's about 1% of GDP, whereas the share of agriculture in GDP is about 25% for low-income countries. So again, on these kind of sectoral breakdowns, you kind of see you see quite big differences. And the relatively low share of industrialization on the continent has also been reflected in fairly weak regional value chains. So if you compare to other developing regions, there is less trade going on within Africa. A lot of the trade is to advanced countries in the form of like the export of primary commodities. So the weak growth in industrialization has also kind of contributed to the kind of trade patterns which we see on the continent. And in our view, one of the issues which has been holding back, the development of the private sector has been access to finance. The chart on the left is showing the credit to the private sector as a percentage of GDP. And for sub-Saharan Africa, that's fallen from 56% of GDP in 2007 to 36% of GDP in 2022. So the pace of bank lending is failing to keep pace with the growth in the economy. And that obviously has implications then in terms of funding investment and development. And I think another way of seeing this is the chart on the right, which is showing the the median capital stock by region. So the capital stock is the productive base of the economy. And if you look at the private capital stock, which is on the right-hand side of the chart, you can see the median capital stock as a percentage of GDP is noticeably lower in Africa than it is in other regions. Whereas interestingly, when it comes to the public capital stock, the stock owned by the government, it's on par. So the difference here, the big difference, is really in the productive capacity of the private sector. So I'm going to move now to some of the questions that we have in the survey of banks. And one of the questions we ask every year is what's the kind of the main issue for banks? What are their main concerns? And in 2024, economic conditions are the main concerns for banks. And actually, this was an option or a response option that we only introduced to the survey in 2024. Before that, we didn't include it. So we can see that economic conditions are a concern for nearly 80% of banks in the survey. So I guess is coming down to growth trends, high inflation, high interest rates, these sort of things. Asset quality is the next biggest concern. I think the asset quality one was a little bit surprising to me because it had increased as an issue relative to last year, even though typically the trends in terms of non-performing loans and across Africa have been pretty solid. So following the pandemic, there were these concerns that we would see a spike in non-performing loan ratios, and that didn't really happen. Even when regulatory forbearance measures were withdrawn by central banks, still we didn't really see much of a spike in terms of non-performing loan ratios. But perhaps banks are concerned that eventually the impacts of higher inflation and higher interest rates will start to impact their clients. And after that, then there's you can see there's a variety of other issues that are also concerning banks, but to a lesser extent. Next slide, please. In terms of profitability, 80% of banks expect profits to be higher in 24 compared to 2023. And 2023 was already a year where profits were higher than the preceding year. So there's been very strong growth in profitability in the banking sector across the last couple of years. In terms of the factors which have been driving it, well, you can see there's a variety of factors which are driving profits higher there, which is the light blue portions of the bar. So it's increases in volumes, changes in non-interest income, and changes obviously in interest income also. And we do a little bit of a kind of a delve into the profitability issue of banks, given that they've been operating in a high interest rate environment over the last few years. Next slide, please. So the chart on the left here is showing the correlation between bank profits and interest income by country. And the first thing to note is that for most countries, there's a relatively high positive correlation, more than 0.5, 0.6, between bank profits and interest income, saying that interest income is an important driver of bank profitability in most countries. In the chart on the left, we also color code the countries with the strongest relationship or the highest correlation between interest income and profitability in blue, and the ones with the weakest relationship between interest income and profitability in red. And if we turn to the bar chart on the right, that's showing the ratio of non-interest expenses to gross income. So it's effectively a measure of efficiency in the bank sector, because if you have a very high share of non-interest expenses to gross income, it means you've got a very high cost base relative to your income. And we have the countries which are colored in red on the left are the same countries which are colored in red on the right. And what it's basically saying is the countries for which there is a weak relationship between bank profitability and interest income are typically the countries where banks, they don't have good control over their cost base. In that kind of scenario, the relationship between profitability and interest income starts to break down somewhat. Next slide, please. Now, as I mentioned, we have been operating in a high interest rate environment, and that's sometimes associated with higher profitability for banks. And normally the channel through which that operates is that banks they reprice the interest rates on their lending to the private sector more quickly than they adjust the interest rate on deposits. So you get a kind of a widening interest margin for the banks on their lending to the private sector. That's the typical thing that you would see if banks are profiting in a high interest rate environment. That's not been the case in Africa over the last few years. So in fact, banks have, for the most part, narrowed the spread between their lending rates and their deposit rates to the private sector. And it may be that in the current economic environment, they are perhaps reluctant to fully pass on interest rate changes to customers for fear that it may ultimately end up pushing up non-performing loan ratios. Instead, what we've seen is that banks have been growing their lending to government more quickly. So for countries for where we have data available, the chart on the right there, the yellow line is the growth rate, the which rate banks are growing their holdings of debt securities, which is mainly government bonds. And you can see that growth rate since 2015 really has been higher than the orange one, and the orange one is the rate in which they've been growing their loan books to the private sector. So they've been growing their debt securities more quickly, and in recent years, because of the tightening in global financial conditions that I referenced earlier, the interest rate on government bonds has gone up. So they've been growing their loan book, and they've been growing their bond portfolios at a time when the yields on those bonds have also been increasing. So those factors have been driving an increase in profitability, but obviously also intensifying the link between the banking sector and government, which is one of the sources of vulnerability for banks in the region. Next slide, please. So I'm going to just talk now about our two thematic chapters in the report. Firstly, digitalization and fintech. We do a stock take of the fintech sector sometimes in the report, and when we did this for the first time 4 years ago, we had 450 fintech firms which were operating in Africa. When we did this again in 2024 this year, it was 1,263 firms. So we're talking about very, very rapid growth in the industry over the last 4 years. And when it comes to financial inclusion, which is the share of adults with access to formal financial services, the growth in financial inclusion over the last decade has really been driven by an increase in the availability of digital financial services. Another thing we've seen rapid growth in is, for example, mobile money, whereby in the space between I think 2014 and 2021, the share of adults with mobile money accounts almost tripled. And we're at a stage now where East Africa alone accounts for more than 40% of global mobile money transactions by volume. A bit lower by value, but more than 40% by volume. If I look at the charts in terms of fintechs and what they're doing, the chart on the left is saying that they are more highly concentrated in the largest economies in Africa, and these are the biggest markets, also more liquid, and you tend to have associated a venture capital industry there as well. And on the right hand side, in terms of their main services provided, payments would be typically the biggest activity, followed by lending. But I know in the panel we'll hear more in terms of the what's going on in fintech. So I'll move on to the next slide, please. Of course, at the same time that you have fintechs growing, you also have a very high share of banks now, which provide some services digitally. When it comes to basic services like transferring money, nearly all banks will allow their customers to do that. You can see that by the very large light blue portion of the bar, the first bar, which is saying almost 90% of banks allow customers to transfer money domestically. When you go down to the bottom and you look at some more complex transactions like applying for a credit card or applying for a loan, restructuring a loan, a lower share of banks offering these types of services online, but we would still have seen growth in the availability of these services digitally from banks over the space of 4 or 5 years. Next slide, please. One question which we have introduced to the report for the first time in 2024 is to get the views of the commercial banks in terms of how they see their central bank approaching fintech. What's the kind of the role of the central bank in their country in relation to fintech. What you can see is that banks typically perceive consumer protection as the main role adopted by their central banks. So nearly 90% of commercial banks see consumer protection as the main role being adopted. And that's followed by over 60% saying that the bank acts as a regulatory enforcer. So you can see consumer protection, regulatory enforcement is the perception of the commercial banks in terms of how central banks are acting. And then to a lesser extent, central banks are seen to be facilitating innovation or educating the public. Of course, there's a variety of roles here, but it's mainly on the kind of regulatory and protection side that banks perceive the central bank as seeing their main role. Next slide, please. So then we also ask banks, what are the barriers for them in terms of investing more in digitalization? Again, there's a wide range of barriers here. The one which is emerging as the largest one is cybersecurity. So as banks put more services online and they become more digital, they're becoming more concerned about cybersecurity. It's starting to pose a greater operational risk. We also have a couple of other factors coming through, such as a limited expertise and knowledge on IT. So we have some human resource bottlenecks, and also competition from the fintech sector can also be a factor which is limiting digital investment by banks. So in the next slide, I will move on to the second thematic chapter and the last issue that I'm going to talk on, which is climate. We ask banks what is the impact of climate change on them so far. The chart on the left is saying that in terms of the amount of banks that have actually experienced physical damage to their assets and to their branch work, it's still pretty small. 90% of banks not reporting any damage. And that's probably related to the kind of more chronic nature of climate change, high temperature and drought rather than extreme storms. We have, when it comes to the impact on asset quality, we have about a third of banks saying that the climate risk has had some sort of impact on their asset quality. Next slide, please. So we also ask banks to assign themselves a label on how they approach climate, whether they see it as a big issue, whether they're engaged. So it's starting from banks which label themselves as cautious, meaning they don't see climate change as a significant risk and kind of do the bare minimum. Followers are kind of slightly more engaged, all the way up to promoters. So promoters see climate change as something which is completely central to what they do and to their business model. So you would say the cautious and the followers are kind of the weakly engaged categories, and the leaders and the promoters are the strongly engaged categories. While the followers is the largest individual category, what I kind of take away from the pie chart is that roughly speaking, about half of the banks are reporting themselves as weakly engaged in climate, and about half of the banks are reporting themselves as highly engaged on climate. And when we look at the bar chart then hit there next to the pie chart, which is basically asking banks, to what extent they offer green finance products, and how big those that green lending is as part of their loan portfolio. What the bar chart is just telling us is that as banks become more climate engaged, you can see that they do more climate lending. And it's quite noticeable as you move through the different categories that there's an increase in the share of banks who are offering green products to their customers. Next slide, please. We also asked the banks what are the barriers to them in terms of doing more climate finance, and we kind of break these reasons down into, some of them are kind of client side barriers. So you can see the first three issues there are that clients lack technical skills, or climate is a low priority for the clients, or the clients aren't aware of the finance options available. And then the ones after that are more issues with the banks themselves. So either they lack capital, technical expertise, or it's not really part of their strategy. And what you can see is that the barriers to climate finance, they kind of span the whole kind of spectrum. The largest individual item listed by banks is low priority for the clients. But banks also list internal issues. So for example, the lacking long-term capital, or lacking the technical expertise. And in fact, when it comes to lacking the kind of the technical expertise and kind of seeing this as an internal barrier, you have a much higher share of banks citing this as an issue when they are in the kind of low engagement categories that we saw on the previous slide. Whereas if banks are highly engaged on climate, they're much less likely to see these sorts of internal barriers to doing climate finance. Okay, next slide. So that basically wraps up the presentation from me. I'd like to thank everyone for listening. It's quite a detailed report. There are other chapters in there that I haven't even touched on, including a kind of regional chapter where we touch on trends in the banking sector, not just at regional level, but also on country level. So if you're interested in any of the issues which have been raised in the report, please go to our website and take a closer look. Thanks, everyone.
Thank you. Oh, okay, Ricardo, go ahead, please.
Yes. Thank you, Colin, and thank you, everyone, for listening. So good morning and good afternoon to everyone. So now my role is then to moderate the next great panel that we're going to have. So we're going to have three persons from different institutions discussing the results that Colin presented, but especially giving their views and from their angles of activity. We're going to have Mr. David Ashiagbor, the head of financial strategy from the African Development Bank. Patrick Conte, the head of the Africa FinTech network, and actually someone that collaborated in the report as well. And then Barbara Marquito, the head of the Country and Financial Sector Analysis Division here at the EIB as well. And the idea, as I was mentioning, is for the panelists to discuss their views on what Colin presented, but especially to give their own experience in the wide topics that we touch upon. I would perhaps, my role is, to fire some questions, and then ideally to give some room then for debate with the audience in the end of this discussion. My first question will be to David. In a sense, to follow up on the first, topics that Colin presented. So to have the sense of what is the IFDB view in terms of the evolution of the financial sector in Africa. So, our report in Colin highlighted that the commercial banking sector has been able to, weather the recent shocks. Is that also the view that you have? And to what extent you see that commercial banks are well positioned to increase lending to the private sector? Not just given the shocks that they faced, but the most recent challenges.
Yeah, good day, everybody, and thanks, Ricardo, for the question. Let me, first of all, start by congratulating the EIB team on yet another excellent Finance in Africa report. It's one of the reports that I look forward to every year, and I think every report has very rich nuggets of information. I think in terms of AFDB and where we stand on the financial sector, I think the report actually reflects very much what we see, right? I think a few years ago, we were very worried about COVID. We were very worried about the long-term impacts. And I think the African financial sector came out of all that better than many people had expected, right? Better than many people had expected. It emerged stronger. We didn't have any major crises. I think what stood out for me from the report really relates to the second part of your question, which is about the decline of private sector credit as a proportion of GDP, right? And I think that reflects what we're seeing in terms of the debt burdens of sovereigns. So if you like, the debt overhang, the recovery from COVID, and all that. Okay. At the same time, I think we've seen in countries like my home country of Ghana, the domestic debt restructuring, which had a huge impact and continues to have a huge impact on the banking sector, and therefore constrain domestic lending. So what I'm seeing from these results is kind of a paradox, right? Where the basic risk-free asset in some situations has proven actually to be the riskiest, right? That risk has crystallized with disastrous consequences. So you're finding people in situations where, okay, I need to lend more to the financial sector, but I can't. Right. So I think it'll be interesting to see how that conundrum plays out. I think in terms of our client base and the banks that we are talking to, we are seeing more and more interest in working with them to reach specific segments, specific areas, be it MSMEs, be it women, be it youth. And coming back to the Ghana example, I think one of the things that we're seeing in that particular market is a renewed interest in looking beyond the sovereign, beyond government bonds. What products can we do? But of course, that in itself is a journey, because there are risk issues. You need to be familiar with the sector. So hopefully over time that will begin to shift. But I think the biggest takeaway for me is actually seeing that stark number in terms of the decline in private sector credit to the private sector as a proportion to GDP. I mean, we all talk about it in our field. We all talk about the lack of access to finance, but seeing that figure actually crystallizes it in a way, in a different way. So I'll stop there. Thank you.
Thank you very much, David. Now, turning to Patrick, I mean, also as a way to start to solve this conundrum, right? I mean, as Colin mentioned in the report, the increase of fintech services has been amazing over the past years across the continent. I mean, not just that. I mean, especially the fact that then also it represents a big share in all the transactions at the global level. So it seems that, although credit is not growing, there is a different ecosystem, trying to fill this gap. Could you bring us up to date on the most recent developments? I mean, more like also from your practical experience, and not just the figures that we were mentioning in the report and that Colin briefly presented before.
Yeah. Thanks, Ricardo. Again, I will want to join David in thanking the EIB for not only enabling the network to be a contributor to this report, but most importantly, the invitation to discuss the findings, courtesy of our joint partner Making Finance Work for Africa. I've had time to go through the reports. I go, David, very informative, very detailed. And kudos, job well done. Speaking specifically to your questions, I think the report sort of highlights the fintech journey in Africa with a sort of transition. Well, not transition, it's still trying to transition from a continent that is largely driven by mobile money accounts, if not the largest in terms of account ownership and volume, in terms of transaction value, especially in East and West Africa. And we see where there are major fintech jurisdictions as articulated in the reports, and that speaks to the reality. Nigeria, leading markets, followed by South Africa, Kenya, and Egypt tailing behind. And also the report reinforces what we already know, that Africa's strength actually when it comes to fintech is in the payment sector, especially digital payment. Perhaps on that note, what I want to maybe share at this point is that it's not only payment. I think there's a critical component of payment that is actually gaining traction, and that's the inclusive instant payments. Last week I was in Accra attending the launch of African Nenda's Inclusive Instant Payments Report 2024. And very interesting highlights. I mean, it shows instant payments are actually gaining significant traction in Africa, just in terms of volume. From 2019, volumes have increased from 14 billion transactions to almost 50 billion as at 2023. And value terms, instant payments have increased from 280 million in 2019 to about 1 billion in 2023. So that's an ecosystem that is actually booming. Instant payments are almost, they're almost near real-time payment, but they are micro payments. And these are of relevance to us at the network because these micro goes to the villages, the rural settings, individuals, account holders or non-account holders. So that's an ecosystem perhaps in the future that the report may want to delve into. So Africa's fintech, as the report says, the payment vertical remains very strong, followed by lending. But lending is not that strong digitally. Jurisdictions like Kenya, even Nigeria, I think Accra have seen tremendous traction. But again, alongside that, what we have seen a high default rate in digital lending. That's another monster to discuss on another day. I think what I would like to share further is what we call less known fintech jurisdictions that are coming up. In places like, especially in Francophone West Africa. If you follow, for instance, the EcoBank FinTech Challenge, which has been on for the last 5 years, is an annual challenge that looks at, invites applications across the board, Africa and beyond, and sort of they are vetted, they go through a rigorous process of assessment to sort of rank the best, startup in the ecosystem. And for the last 2 years, the winners have been coming from Francophone. 2023 from Cameroon, 2024 from Ivory Coast. So for us at the network, what that shows that whilst we have the big names, the leading names like Nigeria, Kenya, South Africa, they are ecosystems, small countries, less known, but they are really coming up. There are bright talents there, there are innovative products coming up. So for us, it's good because I think the challenge in Africa is that you have this dominant market and you have other countries that have a lot of catching up to do. What I want to speak to really to sort of reinforce our views at the network. This is all good, fintech is all good, but I think the conversation now for the continent is about how do we transition from financial inclusion to economic inclusion? How do we as a continent ensure that all of these payments transition into savings, they transition into investment, they transition into economic activities that create jobs and reduce poverty? For us, that's the sort of conversation we are keenly interested in. How do we create economic inclusion, courtesy of the emergence of fintech? And speaking to that, I will want to flag few constraints because these are, I'm not calling them, not calling them, these are challenges. These are red flags that have come to light. If not addressed on a timely basis, they will start undermining the gains we're already making in terms of inclusion as documented in the report. And one thing I would like to flag is the issue of interoperability, especially when it comes to payments. You have providers with several payment rails that are not interoperable. And what that means, it means payment becomes more expensive. They are not instant. They are not quick. They are not fast in the way they are supposed to be. Interoperability is critical. It's much more important, especially at regional and at continental level. As a continent, we have a payment platform that really, ensures intra-African trade, cross-border trade. No, what we have are splinters, separate payment rails, standalone payment rails. So until there is that interoperability of platforms, of rails, as a continent, the issue about economic inclusion will become questioned. Then number 2 red flag that I would like to speak on to quickly is the issue of digital fraud, which I think is not clearly covered, not covered in the report. Again, what we have seen from evidence and interaction with our ecosystem, digital fraud is undermining digital trust, and therefore eroding the sort of financial inclusion effort that we are making as a continent. Numbers are increasing, and I think that sort of speaks to, there is a slide that Colin spoke about in terms of the perception of banks when it comes to the role of central banks and when it comes to barriers. And I think when the banks, I will not speak for the bank, but I think my understanding is the banks are saying consumer protection is critical for them. I think it comes on the back of what we see in the landscape. There is an increasing trend in fraud that is perpetrated digitally. So for us at the network, we have started sounding the alarms to regulators. We have started sounding the alarms to players that whilst we are gaining traction in terms of numbers, volumes of payment, digital fraud is on the rise. So the last couple of weeks, personally and on behalf of the network, we have been working with certain partners to start combating or nipping on the bud digital fraud. So those red lights, those red flags that are in the ecosystem, the earlier we come together as partners to start to address them, the earlier, the better. Otherwise, the gains we are making in terms of all the good numbers documented in the report, number of account holders, number of mobile account holders, those are all good. But if the red flags at these stages are not addressed on a timely basis, they will go to undermine the gains that we're making. Of course, the issue of regulation remains a thorn in the flesh when it comes to fintech's development in Africa. Not only are regulations fragmented, they are outdated. There is a lot of catching up that the regulators need to do. The fact of the matter is, even in the major jurisdictions like Nigeria here, Kenya, South Africa, innovation in fintech, it's all far outpaces regulations. Regulation has a lot of catching up to do in these jurisdictions, let alone the majority of Africa. So for us, fintech contribution is good as documented, but I think there is so much we need to do as a continent, in terms of addressing this pain point to ensure we really galvanize the gains in financial inclusion and then transition to economic inclusion. I would like to stop there for now.
Thank you very much, Patrick. And that's a good segue to my question to Barbara now following, which is, to going back now a little bit to the more macro overview again. And in your view, Barbara, what are the key barriers to unlocking investment in Africa? I mean, Colin already lifted a little bit the veil there, but I mean, to what extent, what are the key barriers, and how can then the continent overcome, with the help of the MDBs and all the international community, to foster a more conducive environment to the private sector growth and to the economic inclusion that Patrick was mentioning?
Thank you, Ricardo. This is $1 million question. Before I get to that, I would also like to take this opportunity to echo Colin's words, to thank our friends in Making Finance Work for Africa for hosting us, and also to thank all the banks who have taken the time to fill in the survey. I think for us, it's a really a very valuable tool to understand what our clients, our prospective clients, see as barriers, as constraints to investment, but also the opportunities. So it's really a valuable tool for us to listen from them. Now, going to your question and the barriers to investment, there are many, of course, and they're context specific. In the report, we look especially to the barriers that banks face when lending to the private sector and supporting the development of the private sector. And this is the 9th edition of this report, and two constraints or two barriers have been surfacing year after year, particularly for SMEs and young and innovative firms, and are the lack of collateral and the lack or limited credit history. And Africa, even in comparison to other emerging and developing regions such as Latin America and Asia, seem to have an issue when it comes to collateral. And obviously this is a structural problem. It takes time to fix. It requires the involvement of the government and the public sector to establish well-functioning credit registry, collateral registers, and also I think it requires some thinking or some consideration of different and more innovative forms of collateral, movable collaterals, for instance, which can be more easily accessible to smaller and younger firms. Another thing to consider is how to make sure that firms, SMEs, but are connected to the banking system, that they work together, and starting with deposit, building a saving and transaction history before they ask for a loan. And this is something that we have been seeing a lot happening in the fintech world, where fintechs typically start offering payment solutions, and then they branch out. They also start offering loans to individuals, to firms, as they understand the financial situation through the payment services provider. So I think one point that is important is that to connect firms with financial intermediaries, the capacity building and technical assistance is also very important. And that is why in our lending, and supporting access to finance, we typically, literally in the vast majority of our operation, provide TA and capacity building. And one initiative I am particularly proud of is a course that we have developed jointly with the IMF, which is specifically targeted on financial development and financial inclusion. The other thing that I mentioned earlier is how barriers to investment are context specific. And for instance, in the survey, we asked banks what are the constraints to invest more in digitalization. And cybersecurity is, of course, the #1 concern. Colin touched upon this. And the second, again, is the lack of skilled staff. So As banks venture more into the digital world, cybersecurity risks are increasing, and banks do not always have enough specialized IT staff to expand their service offerings. So again, the role of education and training is very important to supporting investment, particularly in a continent like Africa, where the demographic trend is well known, and we have a fast-growing population. And I will stop here and happy to take more questions.
Thank you. Thank you very much. Now turning for the second round of questions, one to each of you, but in this case, I would ask you to be more telegraphic than in the first round to allow for some space for questions from the audience. And you already have a few on the chat. I would go back to you, David, and then going into one of the specific thematic chapters that we have in the report, which is the climate financing. As Colin was showing, the report shows that there is a different level of climate commitment or strategy from the different commercial banks, and it ranges from some being more skeptical and others more engaged or like leaders in terms of climate investing. Does this match the perception that you also have from your side? And to what extent, is AFDB also encouraging more commercial banks, to go from the laggard group, to the more trendsetter group that we were showing before?
Yeah, no, thanks. I think it reflects what we are seeing, right? And I'm gonna sort of talk about what we're doing at AFDB and then link it back to the question, if that's okay. So, last year at the Africa Climate Summit in Nairobi, we launched a new strategy for the Africa Financial Alliance on Climate Change, or AFAC. Now, AFAC is a voluntary network of African financial sector stakeholders on all things climate change. That strategy, and I think it's important to point out that AFAC is owned and led by the African financial sector. So we provide the platform, we provide the support, but they decide on what they want to work on. AFAC strategy is based around 5 pillars. There's leadership and awareness, which is building, awareness within the African financial sector of climate change risks and also, importantly, the opportunities. That's one pillar. Second pillar, actually within that pillar, there is also a body of work that is about giving Africa or the African financial sector a voice in the international discourse on climate finance. Then there's access to data. So, when we say green or climate finance, what do we mean? What qualifies? What doesn't qualify? There's climate risk regulation, which is all about creating a policy and environment that supports the mainstreaming of climate risks into financial sector operations. And then there's climate risk management, which is all about the capacity building. And then there is the ultimate objective, which is actually allocating capital to sustainable development in Africa. I think what has surprised us in the AFAC journey is the level of engagement with the African financial sector around climate change. As Colin said in his presentation, and also I think the last year's EIB survey, I think it was particularly revealing, because I remember this statistic of saying that 75%, I think, of African commercial banks are looking at climate change, not only from a risk perspective, but also from an opportunity, perspective. What we are learning from AFAC is that there's a whole conversation around understanding what we mean by climate finance. What are the risks? How do we measure them? What are the standards? there are issues around the global standards and their applicability to Africa in its specific context. So one of the pieces of work we're doing through AFAC is trying to work with the African financial sector to develop an ESG taxonomy for the African financial sector that can, that is adapted to the African context, but also has points of alignment with international frameworks. How do we mobilize the African financial sector to have a voice in the international discourse around climate risk regulation? Why is that important? Because if we don't, we risk, being frozen out of the system, the international financial system, and climate risk becoming another sort of KYC AML issue, right? And we know the impact that has on financial and to quote Patrick, economic economic inclusion. But I think the most important thing that is coming out of this whole discourse on, and I prefer to say climate finance rather than climate risk, because the transition and the whole climate issue also offers huge opportunities for Africa, right? And we have to take a balanced view. It's not all about climate being a risk. It's about there are also opportunities, and how do we work with the banks to identify those opportunities and structure products so that the funding flows to those opportunities. I am personally convinced that African banks are doing a lot more climate finance than they know, but simply because there's no standard of measuring them. For example, if you're helping a company install solar panels instead of a diesel generator, right, that qualifies, but I'm not sure that's being captured. Sorry, I've spoken a lot more than I intended, so I'll stop there. Thanks.
Thank you. Thank you, David. And then Patrick, another question for you, again appealing to your telegraphical capacities in this case. I mean, you explain us a lot in the context of the fintech context in the continent with very specific and detailed cases and of countries and the risks and what is needed to do more to get economic inclusion. But there is some typically a subject that we cut out, I think, in a couple of years ago, even on our report, that there is some sort of competition then between fintechs and banks, right? So to what extent is that still the case? And is that necessarily a bad thing? And what are the pros and cons of having this competition between these two kind of financial services providers?
Yeah, thanks again. What we advocate at the network is we tell both banks and fintech, compete against cash, don't compete against each other. Because the fact of the matter is, even here in Nigeria, at least 60, maybe 40% transactions are still done digitally. Here, that is the most advanced jurisdiction for fintech. Cash is still king. I'm sure if you put the entire Africa together, the extent of digitalization when it comes to cash will be less than 30%. So cash is still king in Africa. So we talk to both banks and fintechs, big techs. Your competition should be how to limit the use of cash. So that's the narrative. So that is not to say there is no competition. So there is an aspect of competition. I think in the early days when fintech started emerging, I think it was like them versus us, i.e. incumbent banks versus, incoming tech guys, very tech savvy. They were smart. They had technology savviness. They are capturing the market. I think those early days saw a bit of brutal approach to competition. It was them versus us. But what we see now increasingly in the recent past 4 or 5 years, I think it's more collaboration and cooperation for obvious reasons. You have fintechs that ride on the piggy bank on the backs of banks for ease of license, accessing approvals from central banks for ease of launching into market that the banks are already involved in. And most importantly, these banks have stronger financial base. They have stronger balance sheets, so they can support fintechs. Then the other way around, you have banks who have been leveraging on the innovative powers of fintechs. They've been leveraging on their technology, on their talent, on their customer user experience and joining to actually improve what they are doing. I'll give a typical case. I mean, EcoBank stands out. I'm not marketing for them, but they stand out as a bank that has demonstrated cooperation strongly with fintech. 5 years now. This is the 5th year running on an annual basis. EcoBank has what they call the African Fintech Challenge for Africa, basically soliciting ideas across and beyond the continent for fintechs to challenge their, present their innovative product to a panel of highly esteemed judges, and then a winner is picked out of a very rigorous process that is on, that is strictly controlled in terms of quality, and the winner takes away 50 grand. It's not so much about the prize money of $50,000. It's so much about the fact that there is a hand-holding process that EcoBank is involved with, because we are part of the process as well. There is a hand-holding process up to the point where the top 10 are identified. They are nurtured. They are supported in terms of knowledge, in terms of access to market, in terms of how to navigate the regulatory environment. That's a typical case of collaboration and cooperation, because what that brings is a win-win situation. It's a win for the bank because they have visibility as to what is happening in the innovation space. They have visibility in terms of increasing their customer base, visibility on technology that is emerging, so they can either step up what they have internally or incorporate. So in fact, we see cases where banks are buying over fintechs. We see cases of mergers. We see cases of fintechs piggy banking, as I said, piggy bagging on the back of banks. So what generally is happening? I think we now see more of cooperation. I think we now see more of collaboration of fintechs and banks working together, which is good for the ecosystem, because it's capitalizing on the power of technology, innovative technology at that. It's all about customers' experience. And let's not forget, Africa is largely defined by largely by youthful population, and these are customers who want efficient services, fast services, largely less expensive services. They want innovative products, because they have access to phones. There is improved internet connectivity, both within and outside urban settings. So the demand side is huge because you have a largely youthful population. So the cooperation and the collaboration, between banks and fintechs, I think is strengthening financial inclusion and gravitating towards what I was speaking about. How do we create that transition from not just making the payment or receiving the payment, but also saving, investing, and multiplying that to create wealth, create jobs. So I think it's more of cooperation that is happening, and that is what we speak. To end, as I said, there is a lot more to be done. The competition must be against cash, not fintech versus incumbent banks. Thank you.
Thank you, Patrick. And the second question for you, Barbara, and then making the link to what David was mentioning already on climate, being also the two MDBs here in the room. So what is the EIB, our case, seeing in terms of climate financing in Africa, and what more can be done to increase the resilience of the African economies to the climate shocks and to the climate transition, or to support the climate transition?
Thank you, Ricardo. And again, I will link my reply to something that Colin has showed in his presentation. So at the EIB, we have developed some climate country risk score. So this is an assessment we do to try and measure the exposure of countries around the world to climate risk. And we look both at the physical and the transition risks. And unsurprisingly, we find that sub-Saharan Africa is the region that globally is most exposed to physical risks. What is important to also, I think, to stress is that the type of physical climate stress to which Africa is exposed is not so much the acute events, the storm, the hurricane. It's more of the chronicle component, no? The heat, the drought, the impact on productivity, etc. And this is having a particularly significant impact on agriculture. Now, what Colin has shown us and shown in the presentation is that many banks find that this is having a low impact on their asset quality, etc., which at first we found as a surprising result. But it's true that this is partly due to also to the low exposure of the banking sector to agriculture. And yet agriculture is the biggest employer in many African countries. I have here in my notes that in 26 African countries, more than 40% of the workforce is employed in agriculture. So going back to the concept of industrialization that Colin was referring to, if there is to be more industrialization in Africa, agriculture itself needs to industrialize. And for this, they need the support of the financial sector. Agriculture needs to look at higher value added, more processing, so that agriculture can create and be part of regional and why not global value chain. And by doing so, it will not only increase industrialization, it will increase climate resilience and also the exposure of the continent to inflationary shocks when global food prices increase. And in this respect, I think from the EIB point of view, we have been doing two things. We have been working to support agricultural value chains by partnering with local financial intermediaries, with banks, to improve the availability of finance, but under a program which aims at greening the financial sector. We have been partnering with central banks and regulators, those who set the regulatory climate framework, the taxonomy is what David was referring to, and one example is our collaboration with the Central Bank of Kenya, which is, I think, at the forefront, as usual, very advanced in terms of climate regulatory framework, and a similar partnership is being developed with the Central Bank of Ethiopia. So I think these are, it's a really important part of what we do to contribute to support, again, private sector development, industrialization, but also climate resilience.
Thank you. And so thank you all for the brief replies. I mean, to have still some participation from the audience, I selected 3 questions here from the chat. The other ones, we can address them bilaterally after the event. So I selected 3 questions, that will, be spread up amongst the 4 of you. And here I'm including Colin as well. And the first one, I mean, I think it would be for Colin. Someone is asking here in the chat, I can just see exactly the name, and that if the crowding out, if there are any significant regional differences in crowding out, so that the question is from Yves Comaklo, if there are significant regional differences in the crowding out index that we have in the report, and to what extent, what is the outlook for 2025? So Colin, 2 minutes or less to reply to this, please.
Okay, yes, you can see in the report there are significant differences by region. The thing to bear in mind is that the index is born of 3 different pillars. So firstly, the supply of government debt, because that's creating demand for bank finance on one side when governments are issuing debt. Secondly, the demand for private sector credit, which is then competing with the availability of public debt. And then thirdly, banks lending decisions. So like, are banks as a whole growing their their loan book, what's happening in terms of spreads. And the thing is, the factors can differ, in fact, by region. Typically, it's the countries where the share of bank debt, public debt on bank balance sheets would be expected to have the highest degree of crowding out. But it's not always the case, because we have a large number of indicators in there, and sometimes, even in countries where you have a relatively high share of bank debt, if they're still growing their private sector loan book, and if they are tightening lending spreads, well then in that situation, you can still say that maybe crowding out pressures are not as severe. So for the in the interest of brevity, I would refer people who are more interested in the details to the report, and there's also a working paper by colleagues who kind of go more deep into the methodology, and I think they even give results down to country level. Thanks.
Thank you, Colin. Then the next question that I selected here from the chat will be to Barbara and David. From the question is from David Meek. How can multilateral banks help the local economy, so the countries, to lend to the private sector and to increase especially the loans to SMEs? So we've been talking about climate and digital, but what are again in 2 minutes each, what could be the main policy tools and or roles for MDBs to boost SME lending? Barbara and David, so can be
okay, very very briefly, because I think I already touched upon on the key points. To me, the solution is a combination of being there, supporting with a patient long-term solution finance, a lot of TA that we have been providing to the banks, and in perspective to also the final beneficiary. And thirdly, and this was also asked in one of the questions in the chat, is also providing tools that contribute to mitigate risk. So portfolio guarantees, etc., that reduce the gap between demand and supply, and also the issue of collateral that I was referring to. So I think the solution needs to be comprehensive, touching upon all the availability of finance, but also the capacity building and the risk sharing. And of course, I think this is providing support to the development of the private sector is complementary to supporting investment directly in Africa, which is the other big part of what the EIB is doing, supporting investment in energy, in many other sectors, and helping also deliver on the priorities of global gateways and the priorities of the European Commission. So I think in a nutshell, these are the key pillars, I would say.
Thank you.
Yeah, thanks. I'll just add very quickly a couple of points to what Barbara has said, and I think we're obviously aligned. I think two things. First of all, we also have to remember that a lot of this is related to the business environment, right? If your treasury bills are at 20-30%, de facto, the number of companies that can actually afford to borrow limited. Second point is I'd like to link it to fintechs and the work that Patrick and his team do. I think fintechs and the whole sort of digital finance area gives us opportunities to develop new products, credit scoring, which will help alleviate the risk, microloans, those kinds of things. So we shouldn't, I don't want to say it's not all about the banks, but you see what I mean. I think that new and emerging technologies also help us to develop new tools to identify these persistent issues, and we shouldn't forget about them. Thank you.
Thank you, David. And then last question here from the chat, also from David Meek. I mean, I will direct this one to Patrick. How can governments invest in infrastructure? And then someone else in the chat also mentions the involvement of governments in fintech. How can then governments help to invest in infrastructure of telecommunications to help then banks to expand their digital capacity? And then the question from David is mentioned specifically, investment in QIC, but I mean other investments as well. And then again, asking you to be brief as well.
Yeah, I think the role of government goes without saying. As David says, they provide that enabling policy environment. Governments are there to create stability, a sense of stability, predictability, especially in policy and regulations. That's crucial, and that's affecting a lot of African countries, lack of predictability, lack of stability in government policies and regulations. That's fundamental. And speaking about fintech specifically, I think in what currently we have been focusing on is government's involvement in what we call data public infrastructure. These are the enabling layers that will drive digital finance. For instance, in Africa, in addition to, ensuring interoperability of, instant payment platforms, which could be from a public good perspective, I think critical thing we have been advocating for to drive digital finance in Africa is digital identity for Africans. Trust me, we are an African in countries like here, you have a bank ID, you have a passport number that is different, you have a national identification number that is different. You go to the US, your social security number identifies you across platforms. You go to the UK, your national health insurance number identifies. Africa lacks that. So that is one space where governments can come in to invest, create the environment, maybe perhaps through public-private partnership approach. Let each African have one unique ID. So whether I'm in Ghana, whether I'm in Sierra Leone, whether I'm in Egypt, Patrick currently has a unique identifier number. That will go a long way to drive the development of financial services. It goes a long way on KYC issues, know your customers, customer due diligence. These are the things that are actually creating problems. Another area that government could come, and I keep saying, policy and regulations is very, 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 very critical. Government in the forms of central banks, because they represent government, that's the honest truth. Financial regulators, their role in ensuring that policies and regulations, they are nimble, they are innovative, they are responsive to what is happening in the ecosystem, must be ensured. But then again, it's a catch-22 situations. Financial regulators will tell you that they lack capital, they lack the financial resources to invest, they lack the financial resources to train their staff, they lack the financial resources, for instance, to roll out what you call supervisory technology, to monitor systems. So it's a complex thing. Government, again, can come in issues about data sharing, which is very critical, data protection laws. Are they harmonized? Are they standardized? I think what Africa, let me not steal it, what Africa faced is because we have 54, 55 countries, we have 55 fragmented policies, 55 fragmented regulations, almost 55 different currencies. So when we are talking about digital finance, we at the network, we are presenting what we call a Pan-African approach. Africa, as a market, must harmonize policies and regulations. The market must be integrated. Until these enablers fall in place, the full potential of digital finance will not be harnessed, and government has a profound role to play in all of this. Thank you.
Thank you, Patrick. And well, so we have a few more questions in the chat, but in the benefit of time, we can then address them bilaterally. Some people know it was kind of referenced a few times. If we're going to share the presentations, yes, of course, just doing some publicity. There is much more in the report than in the presentation, but of course, we'll share it after this session in a couple of days. And then the questions that are in the chat, we can address them bilaterally. So I would like then to conclude then our webinar from here, just thanking, not just everyone that has been attending over the past hour and a half almost, but then as Barbara and Colin were mentioning in the name of the EIB, thanking Making Finance Work for Africa for the support over the past years and the collaboration, and thanking all the banks that have helped us with the survey, and wishing a good day to everyone. And we stay in touch for any questions that you have, more than just the ones that have been asked in the chat. Thank you very much.
Thank you.
Thank you.
you.
Bye-bye.
Bye.